Hey guys, Akil here. Welcome back to another episode of the Trading Coach Podcast. Today, I'm going to share with you the story of a fake trading strategy that caused a lot of traders to lose a lot of money, and of course, give you a solution on how you can avoid falling for that same trap. Now, before we get too stuck in, this is a video episode, so head over to Spotify, head over to YouTube, head over to wherever else you can watch the video version of this if you want the full effect. We're going to be marking up some charts, especially in the beginning as I explain the strategy. If not, I promise I will try my best to verbally walk you through it. So recently the markets have been in consolidation. When I say recently, pretty much all of 2025 has been in a period of consolidation, mainly because of the uncertainty that's going on with the Trump tariffs and the global economic kind of standing. But even more recently this week, we have a non-farm payroll coming out on Friday. That is a U.S. jobs number, which is the big scary thing that happens once a month. And typically you see a lot of consolidation prior to that, as no one really wants to play their hand before they have a good idea of what's going on. So for a lot of traders, this consolidation is junk, it's poo, it's whatever. For me personally, it's actually a really good period of trading because a lot of my strategies come within periods of consolidation. And one of those strategies is going to be trading advanced pattern formations. Now, the other day I did a YouTube video, the Trading Edge video, which I do every weekend on the YouTube channel, showing you a few patterns that were on my radar for the week ahead. And I got an interesting comment from a trader talking about trading a certain part of a pattern, the part that you're not really supposed to trade, and how that looked like a great opportunity. Now, before you go find this guy, because I know how rabid you followers are, it's happened before where I've talked about a troll and you guys found that troll and you gave him hell, which I applaud, by the way. Before you find this follower and tear them to shreds, this was an honest question. It wasn't a trader saying, hey, I just threw money into account and traded this. He was asking a genuine question like, hey, I kind of observed this. What if we did that? And I do appreciate that curiosity. And it reminded me of a hot button topic for me, right? I have two typical hot button topics that like make my brain explode like the guy from Inside Out. One is going to be correlations in the market. And the other one is going to be the aggressive C strategy because it's something that affected me personally and made me feel really bad about myself because it caused a lot of traders to lose money. And again, I'll share with you that story later. But let's first talk about what the aggressive C is. That way you have a good idea of what it looks like. And again, if you're not watching, I apologize, but I will try to do my best to explain it. So starting off, before we can talk about the aggressive C, we need to explain how advanced patterns works. And advanced patterns work. We actually had a conversation about this in the Q&A the other day. It does work because of the buying and selling habits of smart money and big banks. But they work in more of a literal sense, as in they are four-step moves, I guess you can call them, that typically happen within consolidation / cause consolidation. So if we can walk through the most remedial one, I'm going to choose a bat pattern because that's the easy example. We would start with, let's say, a bullish or a bearish move down. So price action would move from a specific starting point, like a pivot point in the market, and it would have a clear directional move from up to down, meaning price is getting lower. We would then see a retracement. So after that down move ends, we would push up a little bit to a very specific Fibonacci point, which is 50% in the case of the bat pattern. So that's like the halfway point of the previous move down. We would then extend down, looking like we're going to put in a continuation pattern, looking like we're going to complete possibly an AB equals CD pattern. But that extension would also fail, meaning that that extension wouldn't go past that original low mark. And then we would make one move higher up to near the initial move that I spoke about, right? And we have all these legs labeled. So the initial leg that starts to move downward is going to be called our X. That deepest move downward to the end of that first bearish directional move is going to be A. I apologize in the background. Every time I record these things, the landscaper comes and starts doing the yard. So if you hear humming in the background, that's my bad. That move that came 50% up, retraced 50% up of the halfway point, that's going to be our B leg. The failed extension down is going to be our C leg. And then the final completion point where we would look to enter is going to be our D leg. So again, if you can see it on the chart, it makes perfect sense. If not, just imagine like a W, right? Imagine that you're looking at price action making a W. And we call these W and M shaped patterns, right? So typically what you're doing here is you're waiting for that D completion to complete, and then you're trading it. In the case of the bat, the D completion comes at the 886 Fibonacci retracement. So think about 80% of the way up from that initial X to A swing high to swing low move. And you're looking to trade it there down to another very specific Fibonacci level. Think about a third of the way down. And what it does is it gives you a pretty okay risk reward. In most cases, especially with the bat pattern, you're going to get more than a 1-to-1 risk reward, which is what we want. But you're never going to get like a 2-to-1, 3-to-1, 4-to-1, anything crazy like that. And that's why patterns are kind of boring. They're not very sexy. The general public doesn't really like them because it's not flashy, but they're very consistent, they're very predictable, and they get the job done. And again, they've been a staple of my trading since really I started becoming good, which would have been back in 2009-ish, I think, is when I actually started becoming good, maybe 2008, 2009, right? So they're kind of boring, but profitable. So what the trader was looking at in this scenario, and again, for you guys watching the recording, you should be seeing a risk reward profile that is about 1-to-1 on my screen. We're not drawing these things out exactly with like ratios and whatever like that. We're just kind of using this for an example purpose. The trader was saying to themselves like, hey, Akil, right? So I understand the pattern. I get that. But I see that you're looking for this very small remedial retracement in order to make profit, a move of about a third of the pattern, or from the A to the D leg. Wouldn't it be more profitable if we look to get involved at the C leg down here, and instead of trading it down, we would trade it up to the D completion? So pretty much it's like, can I hop on this trade in advance? So to kind of put this in a practical perspective, right? When we're eyeballing a pattern, we're drawing everything out, right? We have our X to A, we are A to B, our B to C. Once we get our C leg, that's when we start getting serious, right? We're like, hey, you know what? This might actually complete. It might not turn into something else. This might be the pattern. And we're starting to put our targets on at the D completion. Well, he's saying that, well, since we're starting to make that prediction that the pattern may complete at the D completion, instead of just watching price go all the way up and do that big old move without us being involved just to catch a little bit on the way down, what if we caught that C leg all the way up and made a lot more money? And if you're looking at the risk reward in front of me, just drawing it out casually, you're looking at a 3-to-1 risk reward, which is a lot more than a 1-to-1. And the idea for this makes sense. It makes perfect sense, right? You're making a prediction in the market. You're trying to get on before something else happens. You're trying to get a good risk reward. It checks all the boxes. But the question that a lot of traders forget to ask is there any reason, aside from us thinking that a pattern may complete, that the C leg would be expected, or that we would expect price to travel from the C leg all the way up to the D leg? And the answer is, that's an answer you have to find out for yourself. But the answer is really no, right? The power of advanced pattern formations, harmonic patterns, is that once that D completion happens, once these 4 steps happen in a very specific order, in a very specific way, that is the magic. There's not as much magic in 3 out of the 4 steps happening, right? So if that's the case, do we really have a reason for trading it? We had a discussion in my live trading room this morning about the what versus the where. We're looking and talking about 3-bar reversals, which are an awesome reversal, an awesome entry pattern in the market. So we had a bunch of traders on the platform spotting 3-bar reversals. Hey, Akil, I found one there, I found one there, I found one there. And we had one on, I think it was the euro dollar, or the dollar yen, excuse me. And I was looking at him like, yeah, that's a beautiful 3-bar reversal, but like, would you actually want to trade it? Like, what are you talking about, Akil? It's a 3-bar reversal. Of course I would want to trade it. And I said, no. Let's back up a little bit. Before we look at the what, which is the 3-bar reversal, the entry signal, the thing that gives us power, let's talk about the overall analysis. Are we at a general location in the market that we think price is actually likely to go short? And you're like, well, kind of not really. I just saw the 3-bar reversal. And I'm like, well, that's the problem. As someone who traded double tops for a long time recklessly, when I first learned about double tops, I thought they were the best thing on earth. It was easy for me to understand. It was a nice reversal pattern. Price goes up, it gets rejected. Price goes up again, it gets rejected for a second time. Boom, right? Bada boom, bada bing. The problem was when I went into the market and simply thought I can spot double tops and trade every single one of them, I learned a very quick lesson that is not the right way, because pretty much every most continuation patterns, most extensions at some point form a double top that is then broken to cause that extension. And guess who lost money when that happened? This guy, right? So we want to combine both sides of the market. We want to do our general analysis and ask ourselves the question, are we at a location where my analysis, the location of price, tells me that we're most likely to go short versus long? And then do I have the confirming thing that tells me, hey, this is a sign that confirms my initial suspicion, now I can get involved? And with the aggressive C, we just don't have that. We have an area that it would be like, hey, this is cool if it happens, but we don't actually have any proof. I bring this up not to scare you away from trading it, because there is a good way to trade it. You just have to be very intentional. I knew a trader a very, very long time ago, probably the most brilliant mind I've ever met. He's a doctor from France that lives here in America. And he actually created an aggressive C that worked. And he had the same premise. He's like, man, I keep seeing these patterns. They're awesome, but there's more to be made. And he went on this long mythical journey of like, how can I find a way to take advantage of it? And he ended up doing it. Now, it was a very specific way. It definitely wasn't every single C. Something very specific had to happen at a very specific point for him to be able to take that trade. And that's what I told the trader on who sent the message. I said, hey, it's a good idea, but make sure you have a reason to trade that C. And instead of looking at it as I'm trading the C leg in advance of a pattern, I would look at it as I'm trading the C leg for another specific reason, whether it's that structure, whether it gives you RSI divergence, whether it's a moving average cross, right? Whatever your thing is. And when I notice that, hey, this area of price happens to also be the C leg of a potential advanced pattern formation, then I can trade it up and use the decompletion as like an extended target. We talk about the same thing with home run trades, right? Every once in a while, I take home run trades in the market. And home run trades are trades where I try to get a little bit more than I normally would. Usually I'm conservative. I get in, I grab my money, I get out, I live to fight another day. Home run trades where I kind of swing for the fences and try to get a big target out of it. But I only do home run trades when there is something on a higher time frame that is in alignment with what I see on the lower time frame. That's the way I think I can get more bang for my buck. So I would look at the aggressive C in this similar way if you're someone that's going to try to trade it. Now, the war story and why I get so personally upset and emotional over this is because a long time ago, before we were tier one trading, right, we were trade empowered. You probably, if you listen to the podcast, you probably heard a story about that. But Trade Empowered was the company that trained me. It's actually Triple Threat Trading, and we changed the name to Trade Empowered. They're the company that trained me. I ended up getting hired by them, or I ended up being an independent contractor for them, coaching with them. It was great. It was family oriented, and then the whole thing exploded because of egos and outside forces and blah, 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 blah. Right, and then we broke away, and then I started Tier 1 trading with Darren and Jason, and it was all great since then. But when we had Trade Empowered, we weren't doing the same things that we were doing on Tier 1 trading. In Tier 1 trading, we kind of revolutionized trading education by having community and understanding that, hey, you know, it's one thing to just kind of teach you stuff, but that's not really how you learn, right? You learn by being around others that are on the same page, by helping others, by giving assistance to newer traders, right? It's a community, it's a culture that we created, and that is the best way to learn. And that was also picked up by Forbes magazine, which was pretty cool because we were the first ones doing it. At Trade Empowered, there was none of that. It was like, hey, we teach you, don't really talk to each other. You can talk to us coaches, but that's it. And there's a reason for that. So at Trade Empowered, I started a Facebook group. This is back when the Facebook was a thing and everyone was on it before all these other things came out, right? I started a Facebook group for traders. I just wanted, again, that community. I wanted a place to kind of talk to others, but was different than a lot of the toxic trading forums out there, because in general, trading forums are toxic, and unfortunately, eventually that's how this group got. So we started the group. It starts off all good for like the first couple months, and we're talking trading, we're having fun, we're sharing ideas, all the stuff that you would expect for a group. But eventually, like any group, eventually the bad people kind of seep in because there wasn't any like filter process. Just because I'm a trader, right? I trade, job number one. I coach traders, job number two. I had no interest of adding another job of like managing a form and denying or accepting people on a daily basis. I don't have the time for that, or I don't want to invest the time in that. So we just trusted that good people would come in because typically good people follow us and trolls don't. But the trolls, just like ants, always find a way to get into your house and ruin stuff. It's the beginning of spring, so you know what it is with these ants. They're everywhere, right? We've got cinnamon sprinkled everywhere to deter them from their paths. But the trolls came in and they're talking, and one of the trolls mentioned the thing that I just showed you, and he called it the aggressive C. He said, hey, we're going to look to trade this C leg up to the D leg. And they said it so confidently that a lot of the newer traders who are in that unconscious incompetent stage, you don't know what you don't know, they simply believed them. So I'm come back to this group like a month later after I'm doing some project, whatever like that. I come back and I just see all this talk about aggressive C, aggressive C, aggressive C. And my business partner, Jay Stapleton at the time, said the same thing. He's like, hey, what's going on here? What's going on? And traders have been losing money hand over fist, left and right, because these troll traders are coming in just talking stuff that they don't know anything about. New traders are believing them, and they're going out and trading these things and losing left and right. Now, normally I wouldn't care about traders losing left and right because it's their own decisions. Dumb traders, you take dumb actions, you get dumb results, right? That is the thing. But because it's under our group, people assume that we were teaching it, which made us look bad. And then you know how the internet goes, oh, these guys are fraudulent and blah, 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 blah. So eventually we get in there, we do a PSA, public service announcement, about how like these guys made it up. This is not a real thing. It is fake. It is fraudulent. Do not do it. And then we had to shut the group down, which I was very upset about because at the time, again, that was my only sense of community as a trader. And that's also the reality of most trading forums out there. That's why we say, generally open trading forums are toxic. Now, I don't put all the blame on the trolls. Yes, it's your fault for going in and just saying stuff that is, blasphemous, I guess, for lack of a better term. I do blame the traders as well. And this is where the solution comes in, right? Because it's scary stuff. We see a lot of YouTube videos, we see a lot of tweets and posts and this and that and stories talking about different ways to trade. Hey, try this, do this. It seems like every few months there's something new and trendy in the market that they want to convince you of, mainly to get likes. And it's very easy to trust people, including myself, right? And this is why we tell all of our traders, don't trust us, trust the numbers. But it's very easy to want to kind of, feel that FOMO, like you're missing out because everyone is doing something and you're not. And then instead of taking the long, monotonous way of going about it, you just want to hop in and trade money. The solution is this. I spoke about numbers a second ago, right? Test it. Don't believe anything that anyone tells you, including myself. If I'm teaching you double tots, if I'm teaching you patterns, if I'm teaching you the FTB, the Greystone continuation, whatever it may be, the daily chore, don't just trust it. Don't just be like, I know Akil said it was right, so I'm gonna go and do it, right? You have to test it yourself, right? So many times we've spoken about back testing on this podcast or on this YouTube channel, so I'm not gonna go into details about what that involves, but the thing that you can trust the most, even more than yourself, is the numbers. So if you're curious about the aggressive C or whatever strategy it is that you're hearing about, learn how to trade it, test it, acquire data, and the data itself will tell you if this is something that is worth trading or something that is bogus. Because I can tell you what, I would hope that if a trader invests hours and hours and hours and hours and hours testing something, and the results come out negative, proving that it doesn't make money, I would hope that that trader then wouldn't be dumb enough to go trade it live. It wouldn't surprise me if some did, because I've spoken to a lot of dumb traders who do dumb things, but that should be kind of divider that says, hey, wait a minute, before I go recklessly blow my money, this is giving me negative signs. So you have to do the work on your own. Yes, it's okay to be curious. Yes, it's okay to experiment. All those are great traits of traders. Yes, it's okay to get ideas from the internet, watch YouTube videos, listen to podcast episodes, reels, TikToks, whatever is out there. But after you acquire that information, you can't just go out there and start trading it with live money. You have to go through the correct process. There's a whole other process you should go through before that. But if you could at least do one thing, just one thing, back test it, acquire data, analyze your data, and make sure it's real before you invest any money. If not, you'll go broke. So I mentioned earlier, we were mentioned in Forbes magazines as being the leading innovators in trading education. If you want to be a part of that and part of the community that we have, head over to www.tier1trading.com. I don't promote it nearly enough. Mainly, we just let word of mouth do that for us, and we kind of like to keep our group small and intimate. That way we can actually work with you instead of just you being a number. But head over to the website, start the 14-day risk-free trial, lets you try out the platform, talk to the community, see if it's the right fit before you make any type of investment. There's also no sleazy auto bill or anything like that. Once your 14 days are up, you're simply kicked out. All right, I'll see you next episode. Until then, plan your trades with your plan. Take care.